This week, in the early hours of May 21st, 2026, NVIDIA delivered a god-tier earnings report. First quarter fiscal 2027 revenue hit $81.615 billion, up 85% year over year. One quick note, NVIDIA's fiscal year doesn't line up with the calendar year. Its first fiscal quarter of 2027 covers February through April this year, ending on April 26th. All right, continuing on, data center revenue alone reached $75.246 billion, up 92% year over year, making up roughly 92.2% of total revenue. Next quarter's guidance is $91 billion, plus or minus 2%, far above Wall Street's own estimate. Gross margin was 75%, operating cash flow was $50 billion, and free cash flow was $48.54 billion. NVIDIA also announced another $80 billion in buyback authorization. Its quarterly dividend rose from 1 cent to 25 cents per share. If this were a college entrance exam, Jensen Huang would have finished every question, completed the bonus section, and even helped the teacher grade the papers. But here's the strange part. NVIDIA shares rose 1.3% during regular trading, closing at $223.47. After hours, they didn't keep celebrating. Instead, the stock edged down 1.26%, returning to $220.66. That's the most important contrast in this earnings report. I've seen many people immediately interpret this as Wall Street starting to punish NVIDIA, or the market no longer believing the AI story. I went through the numbers several times, and the more I looked, the less convincing that interpretation seemed. The real story isn't how much money NVIDIA made. It's that what NVIDIA has quietly changed names. Jensen Huang said something I've been turning over in my mind. Customers aren't buying graphics cards. They're building AI factories. The first time I heard it, I thought it was just PR. The second time I realized it was more complicated. Jensen Huang isn't selling money printing machines. He's selling mortgages on the money printing factory. You sign for the machines, depreciation, electricity, and loans. That's what really matters in this earnings report. The market's hesitation after hours wasn't disbelief. It was a faint realization that the back of this perfect exam paper is actually a contract. Welcome back to the Money Daddy Finance channel. Like first, watch next, and may your money-making journey be a long one. All right, let's get started. First, listen carefully to this. Jensen Huang's exact words on the earnings call, as transcribed by Bloomberg, were, "Customers aren't buying graphics cards. They're building AI factories." Then he added that the right way to measure them isn't by the price or gross margin of a graphics card, but by the AI factory's total lifetime cost. How many tokens it produces per watt, how many tokens $1 buys, how much time the equipment is actually working, the production line's lifespan, and so on. I read that sentence several times. This isn't the first time Jensen Huang has used the term AI factory, but this time he explained it much more fully and seriously, almost as if he were defining the term for the entire market. What exactly is he defining? To understand this earnings report, you have to grasp one fundamental question. What is the first principle behind the term AI factory? It isn't simply having a huge amount of computing power. That's only the surface. The first principle behind AI factory is a change in valuation identity. Let me explain. Hardware companies get discounted on Wall Street. Businesses selling phones, televisions, or chips are cyclical. Inventory can blow up and prices can fall. So investors usually give them price-to-earnings multiples of 20 to 30. Infrastructure companies are different. They sell cloud services, electricity, or subscriptions. These businesses have customer stickiness, customers don't leave easily, and revenue behaves like rent. Investors are willing to give them price-to-earnings multiples of 40 to 60. If both companies earn $100 in profit, the hardware company might be valued at $2,500, while the infrastructure company could be valued at $6,000. The difference isn't how much they earn, it's their identity. Jensen Huang's line that customers aren't buying graphics cards, but building AI factories is essentially a new prospectus for the entire market. And it says this, "I'm not selling you a component that loses value. I'm selling you a factory that keeps generating cash flow." That's the most powerful part of this earnings report. Many people focused on the 92% year-over-year growth, the 75% gross margin, and the $91 billion guidance for next quarter. Those numbers matter, of course. But more importantly, together they're helping Jensen Huang complete a change in valuation identity. NVIDIA is moving from a hardware company judged by cycles to an infrastructure company valued at a premium. But who pays the cost? I've thought about this for days, and the most accurate name I can find is changing who signs the bill. In the graphics card era, NVIDIA signed the bills for inventory cycles, price swings, and customer order cuts. In the AI factory era, inventory becomes the customer's asset, electricity becomes the customer's operating cost, and financing becomes the customer's mortgage. Jensen Huang leaves only three things behind: pricing power, buyback power, and control of the ecosystem. Listen carefully. This earnings report is not NVIDIA's victory. This earnings report is NVIDIA's success at putting the cost of victory on someone else's books. Jensen Huang isn't selling money printing machines. He's selling the mortgage on the entire money printing factory. The depreciation, electricity, and loans are all signed for by you. At this point, you might ask, is a tiny 1.26% after-hours drop really worth analyzing in a whole episode? It is, because hidden in that small move are three popular misreadings. In today's episode, I'll rule out each of those three mistakes, then tell you what the real reason is. The first mistake is thinking the after-hours move was a crash. No, the after-hours data from MarketBeat and Bloomberg are right there. NVIDIA closed regular trading at $223.47, then slipped to $220.66 after hours. That's a 1.26% drop. It's not a crash. It's a modest pullback under extremely high expectations. Wall Street has seen major tech stocks fall 10 or even 15% after earnings. That's what a crash looks like. This time, it didn't even reach 2%. So if someone tells you Wall Street heavily punished NVIDIA and the stock plunged after earnings, that's just clickbait. That kind of drop, for a stock worth several $trillion, doesn't even count as a normal daily move. The second misread is that AI demand is weakening. That isn't it either. Blackwell shipments are still accelerating. The CFO's financial breakdown makes it clear. Hyperscalers accounted for $37.86 billion. $6.9 billion went to enterprises and $37.377 billion to enterprise and cloud infrastructure, almost a 50-50 split. Blackwell chips kept ramping up from last quarter into this one. NVIDIA's total supply commitments rose to $119 billion from some level last quarter. Multi-year cloud commitments went from $27 billion to $30 billion, and inventory rose from $21.4 billion to $25.8 billion. These numbers don't look like a downturn. They look like AI factory orders still lining up. So who told you the AI bubble had burst? He probably never read the CFO's financial remarks. The third wrong take is that export controls by China are hurting NVIDIA. Not that either. I checked NVIDIA's quarterly report. This quarter, China, including Hong Kong, brought in $4.50 billion based on customer headquarters, or about 5.57% of total revenue. The same quarter last year was $9.659 billion, or 21.92%. That sounds like a steep drop. But notice one detail. The report specifically says this is based on the customer's headquarters, not the final place of use. China was a drag on total revenue, but it accounted for only 5.57%. If total quarterly revenue still rose 85% year over year, the market had already absorbed that gap. NVIDIA also said something crucial in its quarterly report. It has effectively been shut out of China's data center computing market. Next quarter's guidance assumes no data center computing revenue from China. That isn't news. It was already built into next quarter's guidance. The China issue is fully priced in. That after-hours move wasn't about China. With all three popular explanations ruled out, only one real reason remains. Wall Street realized Huang wasn't selling GPUs this time. He was selling a contract that could change NVIDIA's valuation identity. That hesitation after hours didn't mean investors doubted NVIDIA could make money. They sensed that NVIDIA wouldn't be the only one signing this contract. The idea of moving the bill to someone else is abstract, so I thought the best way was to lay NVIDIA's bills out on the table, one by one. I counted at least 4 bills quietly moved elsewhere. The first bill is inventory pressure. In the GPU selling era, inventory sat on NVIDIA's books. If one generation didn't sell out, the next generation made it obsolete. That's the biggest cyclical risk for a hardware company, and why the market used to discount NVIDIA. In the AI factory era, the inventory is moved to the customer, adding it up under the SEC quarterly report format for the first quarter of calendar year 2026. Microsoft invested $30.876 billion in fixed assets, up 84.4% year over year. Alphabet invested $35.674 billion, up 107.4%. 4%. Meta spent $18.97 billion, up 46.8%. Amazon uses a broader definition there, calling it productive assets, $44.2 billion. $442.03 billion, up 76.7%. Together, the four companies spent $129.75 billion, or roughly 910 billion yuan. These figures aren't pure AI capital spending. They also include data centers, office parks, commercial satellites, and logistics. But the scale is clear. In this generation of AI, the inventory pressure isn't on NVIDIA. It's sitting on the shoulders of these four companies. The clearest example is Meta. At the end of April, It raised its 2026 capital spending guidance to between 125 and 145 billion dollars. The next web reported that Meta's stock fell about 6% after hours when the news came out. That's the first bill being passed along for a signature. NVIDIA sells the chips, and Meta takes on the job of moving hundreds of billions of dollars in inventory. Wall Street has seen this trick before. In August 2019, WeWork filed to go public and immediately called itself a technology company. Adam Neumann took a real estate business built on long leases and short-term tenants, then packaged it as an asset-light platform, even inventing its own accounting metric. Community-adjusted EBITDA, which basically meant leaving rent, marketing, and administrative costs out of the profits. Wall Street marked its valuation down from $47 billion to the point where even $5 billion was too much. SoftBank stepped in, but WeWork still officially filed for bankruptcy in November 2023. What sank WeWork was the question of whether it was really a real estate company or a technology company. NVIDIA is different in one crucial way. It really is making hard cash, and the free cash flow is right there. But that after-hours reaction tells you Wall Street wasn't questioning whether NVIDIA makes money. It was questioning the narrative makeover itself. Second bill, electricity. The Congressional Research Service and national laboratories have both discussed the power demands of AI factories. U.S. data centers used about 176 terawatt-hours in 2023. 1 terawatt-hour is roughly 1 billion kilowatt-hours. That figure was 4.4% of America's annual electricity use. It may not sound like much, but the same report projects a 2028 range of 325 to 580 terawatt-hours, potentially raising the share from 4.4% to between 6.7 and 12%. In terms of generating capacity, that's the equivalent of 74 to 132 gigawatts of new capacity. 1 gigawatt can supply roughly 750,000 American homes for a year. Who pays the power bill? NVIDIA spells it out clearly in its quarterly report. Whether customers and partners can secure capital, obtain power, and finish their data centers on time is crucial to the company's future revenue. Put simply, the power bill, grid connection, and construction are someone else's problem. I sell you the chips, and you carry the rest. Third bill, financing risk. The April 28th to 29th Beige Book included an interesting line. Speculative-grade bond issuance has recently been active, partly because it is financing AI capital spending. Speculative-grade bonds, or junk bonds in everyday language, are low-rated debt. The Beige Book has officially brought AI factory financing into the discussion of financial conditions. That is a clear signal. AI capital spending is no longer just tech news. It is macro financial news, too. The bond market has quietly become the mortgage bank for AI factories. Fourth bill, capacity lock-in and confirmed demand. NVIDIA disclosed that private domestic companies and infrastructure funds invested $18.6 billion, with some of that money going to model companies. Those model companies may indirectly buy from NVIDIA through cloud providers. By now, you probably see the structure. NVIDIA has moved demand confirmation downstream to the model companies. It sells chips to cloud providers, the cloud providers sell computing power to model companies, and then invest in those same model companies. Taken together, NVIDIA becomes the architect of the AI computing market. I need to be very clear here. I am not saying this is circular financing, and I am certainly not saying it is fraud or money laundering. It is a smart business strategy. But a smart strategy and having accounting risks concentrated elsewhere are two different things. That may be what the after-hours market was thinking about. 4 bills are spread across the table: inventory, electricity, financing, and confirmed demand. NVIDIA has quietly put each one in someone else's hands. This is the mortgage contract. Read out one clause at a time. At this point, you may think I am criticizing NVIDIA. Let me correct that. Absolutely not. I have to admit one thing up front. NVIDIA is genuinely an impressive company. In the first quarter of fiscal 2027, operating cash flow was $50.3 billion, and free cash flow was $48.554 billion. What does that mean? Roughly 340 billion yuan in free cash flow. In a single quarter, NVIDIA added $80 billion in buyback authorization, with no expiration date. It raised the quarterly dividend from 1 cent to 25 cents a share. Buybacks and dividends alone returned about $20 billion to shareholders. Put this cash flow statement next to any S&P 500 company, and it's top tier. And I'm not saying Jensen Huang's narrative shift was some kind of conspiracy. Frankly, Jensen Huang is the smartest businessman in this entire AI boom. No one comes close. He truly understands why infrastructure companies earn a valuation premium. He's using $119 billion in supply commitments to lock in upstream capacity and $18.6 billion of investments in downstream model companies, then using $80 billion in buybacks to pull the available shares off the market. Each move is smart on its own. Together, they form an extremely precise piece of financial engineering. I'm not saying Jensen Huang got it wrong. I'm saying he got it too right. So, right that he handed all four bills, inventory cycles, electricity costs, financing risk, and capacity confirmation to everyone else while keeping the three most valuable things for himself: pricing, power, buyback power, and control of the ecosystem. The mortgage on the money printing factory has been sold, and someone else signed it. The owner still holds the patent on the money printer. The contract guarantees annual usage fees, while the patent ensures he can keep raising the price of the next generation printer. That's the most impressive part of what Jensen Huang has done, but it's also the flip side, and the reason Wall Street hesitated after hours. When a businessman gets this clever, the market naturally asks one question. If he wins, who's on the losing side? There's one more detail I want to add. It was stated very calmly in the quarterly report. NVIDIA said that under the current rules and geopolitical conditions, it has effectively been shut out of the mainland's data center computing market. Its guidance for next quarter assumes no data center computing revenue from the mainland. This isn't because NVIDIA lacks the ability. The policy gate is closed. Over there, a replacement ecosystem is taking shape. Huawei Ascend, homegrown accelerators, and DeepSeek-style approaches at the model layer are filling the gap. Jensen Huang's bill-swapping strategy works in the American market because American capital markets are willing to take on that mortgage. Over there, someone else will sign a different contract. Back to the main point. NVIDIA's May 20th, 2026 earnings report was so impressive, it finished the whole exam, answered the bonus questions, and even helped the teacher grade the paper. But that slight after-hours pullback showed that Wall Street had finally seen one thing clearly. Jensen Huang is turning NVIDIA from a hardware company into an infrastructure company. What he sells is no longer called a GPU. It's called an AI factory. The bills have moved from NVIDIA's own balance sheet to its customers' balance sheets. Inventory goes to the cloud providers. Electricity costs go to power grids and local governments. Financing goes to the bond market. Demand confirmation goes to the model companies. That's the full picture behind swapping the bill for someone else's signature. A lot of people ask, what does this have to do with me? Possibly more than you think. Since 2020, nearly every ordinary American's retirement account has held index funds. In the S&P 500, NVIDIA, Microsoft, Apple, Meta, Alphabet, and Amazon together are taking up an ever larger share. And the debt cloud providers issue to build AI factories will eventually end up in bonds, funds, pension accounts, and insurance company portfolios. Remember what I said before? In the AI era, every ordinary person is paying someone else's invisible bill. This NVIDIA report pushed that invisible bill one step closer. Hidden in your retirement account is a monthly payment you never signed for. Break that payment down, and it includes the money cloud providers, spend building data centers, your share of local grid expansions, and the insurance premium bought to cover the risk of speculative grade bonds. You may never have bought an NVIDIA graphics card, but your portfolio is making the monthly payments on someone else's money printing factory. That's what matters most in this earnings report. Let's return to that mortgage contract from the beginning. Jensen Huang handed the market a perfect score. The market turned the paper over and found a contract on the back. NVIDIA is the first party. Cloud providers, power grids, bond markets, and model companies are the second party. At the very bottom, in tiny print, it says, the ultimate guarantors are all the ordinary Americans who hold index funds. The contract has several stamps on it, but in the most important signature box, NVIDIA's name is missing. I wouldn't claim this is definitely how things are. I'm only walking you through the things I can see, in the order they've become clear today. The AI game still has a long way to go. Jensen Huang's move was smart, but we'll have to keep watching to see where the next smart move comes from. Look at human nature through money and truth through power. I'm Come On. See you next time.